Our hyperinflationary future. Paper money eventually returns to its intrinsic value, zero. French philosopher Voltaire, 1729. History does not repeat itself, but it often rhymes. Inflation and debasement of currencies is far from a modern invention. Ancient Greek city-states snuck increasing amounts of copper in their gold and silver coinage until it lost almost all of the original value. The same fate met the Roman denarius, as a succession of emperors used currency debasement as a tool to water down their obligations as they overstretched their military and economy. The medieval Chinese invented the first paper currency, which ultimately lost all of its value as undisciplined governments printed ever more of the currency, even forcing people to accept it under the threat of death. In the modern era, most paper or fiat currencies have an average lifespan of less than 50 years. Even the United States famously outlawed the private ownership of gold by its citizens in the 1930s, and then finally defaulted on its obligations to trade gold for paper dollars to its foreign trade partners in 1971. We also have famous modern examples like Zimbabwe and Venezuela. While under Marxist mismanagement, both destroyed their currencies and their economies as a whole. Now household pets and zoo animals have become hunted game in these countries, as the starving citizens do anything they have to just to find the food needed to survive. Many people still cling on to the idea that hyperinflation can't happen in the United States, or the developed world. Either they are incapable of grasping the concept, or they assume the mismanagement of the economy would never reach the level seen in the past or in other places around the world. It can't happen here. Our famous last words throughout history. The truth is, it has already happened. Inflation by definition is the increase of the money supply. Since the pandemic, the Federal Reserve has increased the base money supply by several $1 trillion, an unprecedented level in such a short period of time. Price inflation, which we are already beginning to experience, happens only after industry and consumers are affected by the increased amount of dollars chasing after the same, or less in the case of the pandemic due to lockdowns, amount of goods and services. Now people are beginning to feel the pinch, as prices for food, rent, gasoline, and other necessities begin to rise. The Fed is reporting inflation rates above 5% per year. Another way to think of this is that at the end of the year, a bank account that had $10,000 in it will only be able to buy $9,500 worth of goods and services. In a little over 14 years, that same $10,000 will only buy half the goods and services it originally would. This by itself is bad enough, but the truth is worse. The average working or middle-class American is experiencing inflation at a far higher rate than the claimed 5% or so percent. This is because the average American spends more of their income on things like food, fuel, transportation, and housing, which have gone up in price more than the Fed's calculated inflation rate. Alternative measurements of inflation routinely come in the high single digits all the way into the teens when the inflation rate is accurately calculated on how the average American actually experiences it with their purchases. This is because the Fed hides the true rate of inflation through a number of methods, such as not actually measuring the cost of a home, instead relying on an unscientific survey of homeowners asking them what they think they can rent their home for, or by hedonically adjusting the prices of goods for supposed increases in quality. Sure, a stock car made in 2021 might be better quality than a car made in 2011, but it's also much more expensive. How much better is the car made in 2021? The Fed decides on its own, and adjusts the official rate of inflation down according to its own numbers. The adjustments are often just a way to hide inflation, which governments are incentivized to underreport. Programs such as Social Security receive cost of living increases to their benefits each year based on the rate of inflation. If the rate of inflation is understated, the government gets to keep more of the tax money, rather than paying it out in the form of increased benefits. Also, economic growth figures such as GDP are adjusted based on inflation. In other words, inflation needs to be backed out of the numbers to determine how much the economy really grew. Elected officials generally do much better during re-election campaigns if the economy is perceived as doing well. Neither political party is above fudging the inflation rate lower to make GDP growth look better while they are in power to improve their chances of re-election. Long gone are the days of fiscal conservatives. Now in the halls of Congress the debate between parties is not on to spend or not to spend, but only how much extra to spend our way into freshly printed debt and for what purpose. Eventually, the debate will be resolved, and trillions of freshly printed dollars will enter the system courtesy of the Federal Reserve, who will undoubtedly buy almost all of the newly issued government debt, even as we are already experiencing price rises at the shops and the fuel pump. Any reasonable path towards stabilizing government finances has long since passed. The only thing a reasonable investor can do at this point is find some way to protect themselves from the inflation which is baked into such a scenario. But how to do so? Traditional investing philosophy suggests a mix of 60% bonds and 40% stocks, increasing the amount of stocks for younger individuals and reducing the amount for older investors near retirement. However, if the rate of interest on your bonds, CDs, etc., are less than the rate of inflation, which all but the most risky types already are, you are only guaranteeing yourself a loss over time, while taking the risk someone may default on that bond. If you instead turn to the stock market, it is already soaring near all-time highs in price. Do you become the greater fool, and buy from others hoping prices keep going higher? The price-to-earnings ratios of most stocks already rate them as overvalued by conventional measures promoted by famous investors like Warren Buffett. Housing and other real estate like farmland have reached new highs as well on the back of easy lending standards, meaning you may have already missed the move in these markets. Commodities are the last undervalued asset class. Some that have been extremely hot recently like lumber, certainly have seen a needed correction in their price, but all the same, commodities offer the last value investment category, but you can't store most commodities efficiently for the long haul. You need something compact, durable, and valuable, like precious metals to carry you past a period of hyperinflation. Silver in particular is still hovering around half its 1980 high in terms of price. What other commodities can you say are below their 1980 highs, much less half of it? Silver is due to catch up with other commodities and markets. Silver is in every new electronic gadget produced, as well as a irreplaceable part of solar panels and other green energy initiatives like electric cars, and the current annual supply is currently far under the projected need should things like electric cars and solar panels be mandated to go mainstream. The most likely outcome in such a scenario is higher prices based solely on increased industrial demand, before we even consider those seeking to invest in silver to avoid increasing inflation in the US dollar. Disclaimer: this blog is for educational purposes only. It should not be considered individualized investment advice. Conduct your own research before making any investment.